Good day, this is part 4 of a 6-part series on the cost of capital, and this session specifically focuses on the cost of equity and how to calculate the cost of equity. But before we get to the calculations, let's just look at the sources of equity. Where do we find equity? How do we obtain equity into the business? And the first one, and that is, you'll see later, one of the better ways of obtaining equity is through retained earnings. Those are profits that are not distributed to the shareholders, but they are retained in the business and they are used to fund future projects and the growth of the business. A very good source of funding for successful businesses. Second one is a rights issue. A rights issue is an offer to existing shareholders to subscribe to further shares, and it is to protect their interest in the company because they are a percentage shareholder in the company. As a shareholder, they are a percentage owner of the company, and it is to protect them from diluting their shareholding, their percentage shareholding. If they do not take this up, obviously there will be some dilution of their shareholding, but they have the right to take up, or the first right to take up, additional shares which the company issues and uses in its growth going forward. Then the two placings of shares. The first one is a public issue of shares. That is normally a listed company offers their shares to the public. They need to comply with certain requirements in terms of the securities exchanges or stock exchanges, depending on what the country approach is. And those security exchanges have certain regulations and rules which you need to comply with to be able to list your company. You have to have a minimum turnover and some compliance, etc. In South Africa, we all think that we only have one securities exchange, which is the Johannesburg Stock Exchange, but we actually have, at this point, we have 4 securities exchanges, and it would be interesting if you go and have a look at those securities exchanges. One of them are fully black owned as well. The last source of funding is private equity financing of equity. That is where the shares are offered to private investors, and it is therefore not a listed company. The dilemma that we have here is that the share or the information of the company is not required to be published, and the shares are not traded in an open platform, which means there might be limitations on the liquidity of your investment, as well as the information, the available information that you have on deciding whether to invest or not. So what is the cost of retained earnings? And we first need to understand where retained earnings come from. It is the profits after tax that is attributable to ordinary shareholders. So it's even after we pay the preference shareholders, like we discussed in the previous session. Once we pay the preference shareholders, the money that remains are available to distribute to the ordinary shareholders. It can be done into one or two ways. First, it could be paid out as dividends. Then the money is gone for the business. It, however, is in the hands of the shareholders, and it does the attitude of the shareholders good so that they can continue with the investment in the company. So shareholders require some dividends. But the portion that's not being paid out is then the retained earnings, which is retained in the business so that the company can grow or reinvest the money and grow through that process. It is, however, important that the company needs to return a higher return on that money, the retained earnings, than what the shareholder can do on the outside. So if we have not paid the money out, we need to make sure, the company needs to make sure that they do invest in profitable, value-adding projects so that they can add value to the shareholders' interest and therefore incentivize the shareholder to retain their investment in the company. The big benefit, however, is that there are no flotation costs. So there are no issuing costs because the money is already in the business, and that makes a big difference on the costing structure and also the timing, because to issue new shares, to do a rights issue, public issues, etc., takes time, and the company might need the money more quicker to invest in a specific project, and therefore retained earnings is a very good source of funding in this regard. What is the cost of issuing new shares? As we already said, there's some flotation costs. So we've got, again, a merchant bank or somebody that assists us with the issuing of our shares, the prospectuses that needs to be made available to potential investors, roadshows that needs to be done so that we can secure the best price, and that is because of the amount of advertising and offer in the public that is being done. The new shares are often offered at a little bit of a discount to the current market price, and the reason for this is that we want to create demand for the company shares, and as soon as there's demand, obviously there's a taking up of more shares, as well as the market price are supported in an instant or in an environment where we are issuing more shares. We also need to incentivize the current shareholders to take up some of these shares because their shareholding will be diluted by issuing more shares. And the market could also interpret the issue of new shares as a not so positive sign, and that the company would like to, or that the company needs money and therefore cannot borrow money from the financing institutions, and that might suppress some of the activity on the share and the share price itself. Doing the calculations on the cost of equity, there are two broad calculations that we will be focusing on. The first one is the dividend growth model, and the second one the capital asset pricing model. So let's start with the dividend growth model. Here we've got two scenarios. The one is the dividend growth model for retained earnings, and the other one for the issue of new shares. But the formula is the value of the current share price, or the value of the company, is calculated by dividend 1, and it's important that we see it's dividend 1. It is not the current dividend. It is the dividend of the first year after the current year, and it's often misread, and therefore the calculations are done on the current year. It's not. It must be the first year after the current year. And then there's the required rate or return on the equity and minus the growth rate. So when you look at the retained earnings part, it is the dividend 1 divided by the current share price, and it is P0, so it is the current share price without any adjustments, plus the growth rate. So we're rearranging the dividend growth model to isolate the required return for the equity. So that's for retained earnings. When we use the same formula for new shares in issue, it's exactly the same formula. The only difference is it is not the current share price, but it is the net share price or the net value of the shares that we will get. So it is after flotation cost has been deducted. So a small difference, but it's important that we see this and that we consider when we're doing calculations. Are we working with retained earnings, so there are no flotation costs, or are we working with new issues? Then there would be flotation costs to be considered. There are not always flotation costs, but we need to consider that and bring that into our calculation. Moving forward to the capital asset pricing model. Capital asset pricing model consists of a few elements. The first one is the risk-free rate, and you'll remember then we add to that the risk premium, and the risk premium consists of the market return minus the risk-free rate, and we then adjust that by the beta, and the beta is the current or the company's performance relative to the market. So just review the capital asset pricing model and the calculation around this. We've done that in one of the previous modules. Capital asset pricing model, however, is a single factor model because it's the beta. It considers the changes due to the beta. But other models are also available. Arbitrage pricing theory, for instance, that is a multi-macroeconomic factors model. So it considers many more variables than just the one single factor as in capital asset pricing model. But for the purpose of this module, we're going to discuss and focus only on the dividend growth model as well as the capital asset pricing model. So that brings us to the end of this session on the cost of equity, and